In question one, we're asked to consider table 36.3 and we're asked to fill in the blanks. So we're given bottom 20, bottom 40, bottom 60, bottom 80, and the top 80, top 60, top 40, top 20. To fill in the blanks, you just have to take 100% and subtract it by the one that's given. So to get top 80, it's just everyone minus the to get the top 80, it's just everyone minus the bottom 20. So top 80 would be 99.2, top 60, 95.1%, and then bottom 60, 14.4%, and then bottom 80, 31.3%. And then B, given this data, which are the following are true? The bottom 60 of taxpayers pay less than 25% of the federal taxes. That is true. The bottom 60 pays 14.4%. 2. The top 80% of taxpayers pay over 98% of federal taxes. That is also true. The top 80 pay 99.2%, which is above 98%. Part 3. The top 40% of taxpayers pay less than 60% of federal taxes. That is false. The top 40% pay 85.6% of taxes, which is higher than 60%. Question 2, we're given that in 2017, corporate income taxes were about 9.9% of total federal revenue. We're asked to use the figure 36.6 to help estimate what fraction of GDP represents corporate income taxes. If we look at the figure, we see that the total federal revenue or GDP was roughly 18%. So since corporate income taxes were about 9.9% of total federal revenue, we can just multiply 18% times 9.9%, but then we have to multiply it by 100 to get an accurate estimation. So we get it to be about 1.78%. That's how much it represents of total federal revenue.
In question 3, we're looking at a fictional economy with a flat tax of 20% after the first $10,000 of income. We have a table to fill out here where we calculated the taxable income by subtracting $10,000, tax due by multiplying that number by 0.2, marginal tax rate, which stays the same above the 10,000 threshold, and average income tax by dividing tax due by total income. So in order, the taxable income we filled out is 10,000, 40,000, 90,000, and 990,000. The tax due is 2,000, 18,000, or 2,000, 8,000, 18,000, and 198,000. The marginal tax rate stays the same at 20%, and the average income tax rate is 10%, 16%, 18%, and 19.8%. So the marginal tax here is never less than the average tax of 20%, which makes sense because as the average tax is never going to be greater than 20%, it's just going to approach 20 as the income gets higher and higher. And then for part D, an accountant making $50,000 a year will give $8,000 in taxes, as 20% of the taxable income, which is $40,000, ends up being $80,000 or $8,000. Moving to question 4, most federal transfers of money go to elderly, as Social Security and Medicare make up a huge portion of the federal spending, while welfare, unemployment, and Medicaid, the funding associated with lower incomes, make up a significant but smaller portion. And for Part B, the majority of healthcare spending also goes to the elderly, as Medicare applies to primarily elderly people and makes up a bigger portion of the federal budget than Medicaid, which goes primarily to lower income people.
In question 5, we're looking at who gets a greater net benefit under the Social Security program. So comparing women versus men get a greater benefit because they statistically make more than women do, so that increases their Social Security payouts. Married couples versus singles, married couples are favored because each individual in a marriage can claim their spouse's earnings record. People born in 1910 versus 1965, those born in 1910 are better off because the Social Security tax rate keeps increasing, so older workers are better off than newer workers because newer workers are paying, older workers are receiving. High income earners versus low income earners. Low income earners get a better deal from Social Security because they earn a higher percentage of their earnings through the program. Number 6 is talking about a pie chart on the U.S. budget, and we're given a bunch of true or false questions to answer. So Part 1. Most of the federal budget is spent on welfare and federal aid. This isn't true because even if you add up unemployment, welfare, and all other costs, which includes foreign aid, it's still less than half. So part 2, about half the federal budget goes to Medicare, Medicaid, and Social Security combined. That's true, it's about 48%. Part 3, more than half of the federal budget goes to Medicare, Medicaid, Social Security, and interest on the debt combined. This is true, it's a little over 55% if you add all those up. And part 4, the federal government spends about $1,830 on the military per person in the United States. That's true. We did the calculation using the 2017 population and the defense spending from the chart and got about 1,898 per person, so pretty close.
For question 7, we're looking at a future projected spending, especially federal spending, and we're looking at 3 things here: Medicare, Medicaid, and Social Security. For part A, we said that Social Security won't be rising as much as the other 2 in the category. For part B, we said that the everything else category is projected to decline in future decades, which includes military spending and so on. For question 8, we're interested in seeing how enactment of payroll tax will affect employment as well as wage. So in this case, we're looking at the supplier of labor, who are the employees or workers, and the demand in this case will come from the firms. For part B, we want to illustrate the pre-tax equilibrium point. And so here the equilibrium point is going to be the intersection of supply of workers and the demand for workers. So here we marked with orange dot the first equilibrium point, where it indicates the equilibrium wage and the equilibrium quantity. And that is all before the enactment of the tax. For part B, we're looking at what happens after the payroll tax has been enacted. So after that happens, the firms will be more reluctant to hire workers because, well, the more they hire, the more they have to pay, and so the more it costs them. For each new employee that is brought into the firm, they will have to pay the payroll tax. And therefore, the demand for labor coming from the firm side will decrease drastically. And shown here on the graph is the shifting of the old demand for workers curve to the new blue curve, which is the new demand. And marked in purple here is E2, which is equilibrium point 2, and that shows us the new equilibrium wage as well as quantity. So naturally, coming to part D, we see that in the new equilibrium, we see that workers' take-home wages are much lower than before. In part E, if the most workers want full-time jobs regardless of the wage level and their take-home wage, we will see that the labor supply is extremely inelastic, and that is virtually a vertical supply curve. And since firms see that lowering the wage in order to compensate for the fact that they must pay payroll tax didn't result in a loss of workers, they will actually keep burdening the workers with more wage cuts. Now let's look at question 9, where we're looking at the differences between federal debt and federal deficit. The deficit are calculated on a per year basis, while the debt is cumulative. And that is going to be the main difference of the 2 terms. And showing in the graphs are our values.